this is Marcus, and in today's video we're going to be talking about Stock Market 101. This is pretty much an overview of all the basic information that you're going to need so that you can have all the fundamental knowledge if you want to jump in the investment game. I know a lot of folks are talking about investing and trading and putting up their stocks and everything, so I just wanted to provide everyone with a background so that if you want to get in the game, you can jump in and get into the stock market investing game. Essentially, this video is going to be broken down into 4 parts. The first part we're going to talk about is what is the stock market. The second part is going to be how to make money in the stock market. The third part is going to be about researching companies and ways to perform and conduct research into companies that you're thinking about investing in. And the fourth thing that we're going to talk about are ways to invest. Before we get into this video, if you're interested in following my debt-free journey and learning about finance, I invite you to subscribe to the channel and definitely hit that like button because it'll help the channel to grow. Now let's go ahead and dive right in to the stock market. What is the stock market? I know we've been hearing stories, and we've always heard stories of people who made millions in the stock market, people who lost millions. I mean, the past 2.5 weeks we've been flooded with GameStop and AMC, and I honestly don't want to hear anything else about GameStop and all these Wall Street vets and Redditor guys. Like, I don't know, that's for the guys out there chasing money and speculation. That's not my style of investing. I'm a little bit more conservative, but I'm tired of the GameStop Wall Street vets. I don't even want to hear anything about that. The stock market is a public form of companies who decided to go public, and they allow individuals like myself and you to invest and become part owners in these companies. So now let's talk a little bit about the difference between a privately held company and a publicly held company. Essentially, with the stock market, companies become public and make shares of their company available for people to invest in because it's a way to finance future growth. Considering that, when we look at privately held companies versus publicly held companies, this is essentially the difference. A privately held company would be the equivalent of Mark Cuban owning the NBA franchise, the Dallas Mavericks. Mark Cuban is the owner, he's the CEO, he makes all of the final decisions. I can't go on my financial app on my phone and buy shares of the Dallas Mavericks, and even if I could, I probably wouldn't want to. But I just don't have that option because it's a privately held company. Whereas, let's look at the Green Bay Packers. The Green Bay Packers is a very unique NFL franchise because the general public can invest in the Green Bay Packers. They have a board of directors. They don't have one owner. It's owned by shareholders. And so that's essentially what a public company is that's on the stock market. Let's say we had Marcus Corp, and I wanted to increase income in my company so I can reinvest in my company and grow my company. I could say, hey, I'm going to make 20% of my company available to the public and go public so people can buy Marcus Corp stock on the stock exchange. When people buy this stock, I get that influx in cash. I reinvest it into the company. The company grows, the stock goes up. That's essentially how the stock market works and how publicly held companies work. Now let's talk a little bit about the indexes. There are essentially 3 main indexes. There are actually a bunch of indexes, but we'll talk about the big 3. We have the Dow Jones Industrial, which is essentially an index that contains the 30 largest companies. And then you have the S&P 500, which contains 500 of the largest companies. And then you have the NASDAQ. The NASDAQ is essentially an index that contains all of the tech companies. So those are really the 3 indexes that people use to give you a general understanding of how the market as a whole is doing at any given time. So you'll hear the Dow Jones is up 3% or the NASDAQ is down 2%. Well, there's a bunch of tech companies within the NASDAQ, but we know that in general the tech side is struggling today because they were down 2%. So that's really how the indexes play into providing an overall perspective of how the market is doing in general. Now we're going to talk about one of the important things is ways to make money, or in some instances lose money, but ways to make money in the stock market. The first way that an individual can make money in the stock market is essentially through appreciation. That's when an individual sees a company that they want to buy. For example, Tesla, they buy Tesla at $700 per share. Tesla continued to grow and thrive, and their profit and market share in the electronic car arena continues to expand and grow. So that stock price goes up from 700 to 1,000. So now you've essentially become wealthier because that stock that you had and bought at 700, you made an additional $300 on it because it went up to $1,000. One thing we have to realize is that gains with stocks aren't realized until you actually sell those stocks. So if you buy it at 700, the stock appreciates to 1,000. Yeah, you can count $1,000 for purposes of your net worth, but that's definitely not any realized gain because tomorrow it could drop down to 600. So it could throw those numbers off when you're looking at your net worth. But in general, when you want to have actual realized gains, those gains come from when you sell the stock and you actually get cash in hand. Then that's profit that you actually realize. The next way that you can make money is through dividends. Essentially what dividends are is you have some companies who are publicly traded companies, and these companies, once they get profits, when they have an excess in profits and cash on hand, they decide not to reinvest into the company, and they decide to give their shareholders a cash payout every quarter. McDonald's, Coca-Cola, I think AT&T is also a company that do these dividends. And so when you get dividends, you have pretty much two options. You can take your dividends because they count as actual cash, and they cut you a check and you get the actual physical cash. Or a lot of people elect to reinvest their dividends into the stock so their money can continue to grow with compounding interest. And there's a really fast way that you can make a good amount of money on the stock by reinvesting any dividends that the company pays out to you. One thing that you have to be aware with dividend stocks are essentially for those blue chip companies. And so you'll have blue chip companies, and you have or blue chip or large cap companies, and you have small cap companies. Blue chip, large cap companies, those are the companies that have been around forever, that aren't going anywhere. Those are the companies that have longevity. PepsiCo, Coca-Cola, Kellogg's Corporation, Johnson and Johnson. Those companies aren't going anywhere. They've been around for decades. And so companies that pay dividends tend to be blue chip companies that have a lot of excess cash available on hand to actually pay out. The pro with these companies is that you actually get this dividend paid to you every quarter, and you're going to see a constant growth. One of the cons with these large cap companies that pay out dividends is the growth is a really slow, consistent growth over time. So there's literally a small amount of risk, but there's also a small amount of reward. As opposed to if you actually invest in a company that didn't pay out dividends, it's a smaller company, they have much more room for growth, they have much more room to acquire a new market in whatever area that they're working in. But again, the downside is they have that room for risk. So your more stable blue chip large cap companies, essentially less risk but much less reward. Those small cap companies that have a lot of room to grow, you have more risk, but the reward can be exponential. And the prime example I would give is Tesla. I mean, it's $700 a share, which I think is a little overinflated, but I digress. That's another video for another time. The next way that you can make money from stocks is by shorting the stock. This is something that I would consider is more for the advanced investor, not someone who's just starting out or a novice or intermediate. Essentially, when you short a stock, an investor is looking to make money when the stock actually loses money. This is what we saw with the whole GameStop situation, where Wall Street was betting that GameStop was going to lose money, and then a bunch of guys on Reddit said, nope, we're gonna dump a bunch of money into GameStop and drive the price up, so you Wall Street guys get screwed over. Essentially, a short is when the seller borrows security and sells it on the open market at a later date, and they have plans to buy it back at a lower price point. Short sellers bet on and profit from the drop in the security's price. Short selling is definitely high risk, high reward, but losses can mount quickly because a lot of people engage in shorts and they use margin. And essentially what a margin is when you're investing with borrowed money that does have interest accrued on it, which is something that I definitely wouldn't advise if you're going to invest and you don't actually have any of those high-speed series license or not very knowledgeable. It would definitely behoove you not to invest on borrowed money. That could be a catastrophe. The next way that you can make money in the stock market, which again is what I would consider advanced investing, is by options. You have a call option and a put option. Essentially what an option is when an individual buys an option contract, and that contract gives them the right to either buy or sell a security within a certain time frame. I know that sounds a little convoluted, but it's essentially an option is a contract for the right to either purchase stock or sell stock for a certain amount of time. A call option gives the option holder the right to purchase a stock, and a put option gives the option holder the right to sell a stock. Essentially, think of a call as a down payment on a future purchase of a particular stock. I'm buying stock A for $20, so I have this option for stock A at $20 per share. When that stock subsequently go up, I have the right to actually sell that stock to make income on the difference between what I purchased that stock at and what the stock is currently going for if that price went up. And the put option is essentially the same thing, just in the reverse. And again, if you're watching this video to learn about just the fundamentals of the stock market and investing, I think the options, shorting, those things I would leave to the persons who've been doing this for a while, who are a little bit more advanced, because when you get options contract, you generally have to buy options contract in bulk. You can't say, I'm going to get an option contract for 1 share of Tesla. That's not how it works. So generally, you're talking 100 shares. So it's big risks, big rewards, high stakes. So now let's take a look at the ways that you can research companies to make a determination if you want to invest your hard-earned money into these companies. First, you have a technical analysis. Essentially, a technical analysis is when an individual looks at charts and graphs to identify trends in a particular company that will allow them to anticipate if this company is going to have either an upward trajectory or a downward trajectory. So this is when you see on the old school movies an individual sitting in a room with 50 computers around them, and they just looking at numbers and pie graphs and all of these charts to make that determination. A lot of this data analysis is done using computers. So a lot of the big hedge funds and Wall Street guys, they have computers that has these complex algorithms in it that can look at all of these data points and charts in a particular universe of information and make a determination as to where a particular stock or fund may go, if it's going to go up or down. And the investment is done based on that data point that the computer identifies, whether it's an upward trend or a downward trend. The next thing you have is a fundamental analysis. This is kind of where I fall on. This is the old school approach where you look at the common sense things that any business would need to be successful. That takes into consideration the profits earning ratio. It takes into consideration the company growth over a certain time period. It takes into consideration a company's particular market share. For instance, Tesla. Tesla is doing really great right now, and the reason Tesla is doing so well because a lot of people are expecting Tesla to have 30 to 35% of the electronic car market share by the year 2025. However, I know from research that Tesla is currently losing market share in Europe, and GM recently released, this was maybe 6 months ago, that hey, come 2025, they're going to be in the electronic car business hard. So I think it's a far-fetched to think that Tesla will have 30 to 35% of the electric car space just come 2025. I think Ford, GM, a lot of those Chinese companies, I would be shocked if it happened, but that's essentially what a fundamental analysis is. You look at the common sense things that a business needs to be successful. How much debt are they carrying? How much available cash do they have on hand? To find this information, when a company goes public, they're required to do annual disclosures to the SEC in quarterly reports. These are called the 10K report. These reports essentially have all the profits, earning margin, everything that you would need to make an informed fundamental analysis decision on a particular company that you may be interested in. Another thing that you also have to look at when you're doing a fundamental analysis is the leadership. It's very informative and helpful to know that the new CEO, for example, of Yahoo came from Google. I mean, that in and of itself will probably drive the stock price up if that was a particular scenario that you're looking at. But that's what a fundamental analysis is really a common sense approach. Warren Buffett uses the fundamental analysis. Next, we're going to talk a little bit about the different ways to invest. You can invest in an individual stock. Essentially, an individual stock is an individual stock. Hey, I want to buy 1 share of Tesla. I want to buy 10 shares of AT&T at $29 per share. That's investing in an individual stock. The reward in investing in individual stocks is when that company takes off, so does your profits or your potential realized profits from that company, because you have stock specifically, especially in that company. The downside is exactly the opposite. If that company does bad or comes on a hard time, your money is going to go and come on a hard time. Trust me, I know. I invested in a company once, and I tried to ride it out, and I woke up one day and it said 0. My face was tight. Oh man, I was hot. But you do have that option to look at and invest in individual stock. The next type of vehicle that you can invest in is a mutual fund. Essentially, a mutual fund is a group of collective stocks in one fund that you can invest in that's managed by a manager. So most of the times these mutual funds, you actually have to reach out to somebody. There's a contact person. This person does all the research and select these stocks to put in this collective fund that people invest in. And of course he makes money because he charges fees annually and sometimes based on certain transaction if you decide to sell some shares or something to that effect. The interesting thing, I think the example that everybody uses the cookie jar. So if this is a cookie in my hand and this is a cookie jar, a single stock is 1 cookie, chocolate chip. This chocolate chip cookie is Tesla. Now, if you have a mutual fund, this is the actual cookie jar, and inside of this cookie jar, we got a chocolate chip Tesla cookie, we got my favorite oatmeal raisin Microsoft cookie, and we got a whole different variety of companies inside of this fund. So when you invest, you're not investing in one single company, you're investing and your money is spread out across a bunch of different companies, a bunch of different flavor cookies that are in the cookie jar. So that's essentially what a mutual fund is. The next type of instrument you can invest in is an index fund. Essentially, an index fund is exactly the same as a mutual fund, only it's managed most times electronically by a computer. So the index fund, essentially, it's a collective group of stocks that track a particular index. Like these collective group of stocks may track the S&P 500. That's really what an index fund is. The same way to kind of spread your money across the board, across different companies. One of the advantages is that a lot of times, because there's a computer algorithm that does the selection of the companies within this index fund, you save a lot of money on fees that manager would be taking if you had that mutual fund. The next type of fund is an ETF, and essentially what an ETF is, in short, an ETF was created because now the stock market is so accessible to everyone. Everyone has an app on their phone that they can go and look at their portfolio, look what's in their investment account, they can buy, trade, they can do all of that stuff. So essentially what an ETF is, it's it was a creature that was really created to support all of these new people that came into the investment game through these apps. The same concept again as an index fund or a mutual fund. It's a collective group of funds, but was really created out of a creature, out of necessity, really based on these individual apps that have been created. Because with a mutual fund, you had to get invited to the party a lot of times, and if you had an app, you can't reach out and call the money manager. And so that's really kind of what created the ETF and what an ETF is. And the next thing you have is a REIT. Essentially, a REIT is an investment group that invests in real estate. Me, I invest in real estate because I have actual real estate property and I receive rental income every month. But if you want to invest in real estate but you don't want to actually have real estate, you can invest in what's called a REIT. This is a collective group of companies that sole business is the investment in real estate. One of the great things about REITs is they always pay a great amount of dividends because REITs The fundamental purpose of a REIT is a conglomerate of companies and corporations that engage in investment properties. So they get a lot of rental income, so there's a lot of cash flowing through a REIT. And so because of that, federal law mandates that 90% of their profits have to be distributed in the form of a dividend. So if you get a REIT, you're definitely going to get a dividend, but it's a way to invest in real estate without having the actual headache of a tenant tearing up your house and it's being roaches and cereal and spoiled baby milk and diapers someplace it shouldn't, like in the chimney. Yeah, in the chimney of the fireplace or something crazy. So yeah, that's a true story, but I digress. If you're trading and you're holding a stock for less than a year, you're going to get taxed at a much higher tax rate, as opposed to if you're actually trading, you hold the stock over a year, you get taxed at a much lower tax rate, the beautiful capital gains tax. So, those are essentially the fundamentals of the stock market and information you need to know to actually get started in the investing game. That's it. That really wraps up this whole thing of investing or stock market 101. The old saying is the best time to start to invest was yesterday. The second best time is today. I appreciate you all tuning in. Like, subscribe, comment. Take care. Peace.